Coming up.
By definition, uninsured mortgage holders are less likely to default. They have more equity in the value of a house. Why are we asking uninsured mortgage holders to effectively cross-subsidize the mortgage rates of insured mortgage holders?
Some of my constituents have said to me, well, look, like, if we could make it easier for me to get a mortgage or allow me to borrow more, then I could afford to buy a house I wouldn't otherwise be able to buy.
Surely you'll agree with me, Mr. Rutledge, that now is not the time to put in additional barriers for builders to build houses when, as the president, I believe, of the home builders said, there's not a chance we're going to hit our target.
At a breakfast that a number of us attended yesterday with Bank of Governor officials, we were talking about housing, and I learned that in a number of different countries, they do very different things with mortgages. Some countries allow you to port mortgages over 8 years and 80 years and a number of generations.
On empirical data, vulnerabilities have not worsened since that time.
So why use that language? It's clearly inflammatory language in a public report. Yeah, why use that language? I mean, you don't use it unless you're concerned about something. It doesn't sound like you're all that concerned based on your testimony.
This Guy's Garage. Like and subscribe.
The published annual risk outlook, we remain intently focused on the key risks facing the Canadian financial system, including real estate secured lending and mortgage risks, wholesale credit risks, funding and liquidity risks, and integrity and security risks related to the geopolitical environment. It's our job to make sure that lenders remain resilient while adapting to evolving risks in financial markets. And with that, I'll be pleased to take your questions.
Rutledge, and I'm sure the members have many questions, and we are starting our first round with each party with up to 6 minutes of questions. We'll start with MP Chambers for the first 6 minutes.
Thanks, Mr. Chair. The Competition Bureau has recommended that that we consider changing the stress test for people who are with uninsured mortgages. The government has changed the requirements, or at least indicated that those who are insured don't have to do a stress test on renewal, so they can shop around and get a new lower mortgage rate. Is OSFI considering changes?
Thank you, Mr. Chair. So to start with the facts, the member is absolutely right in his facts. If you have an insured mortgage and you seek to renew it in an alternate lending institution, you don't have to go through mortgage stress tests or any other underwriting check. By contrast, if you have an uninsured mortgage, you do. And that is an imbalance. And the Commissioner of the Competition Bureau and I have spoken about that. From our perspective, our job is to make sure institutions underwrite mortgages safely. And one of the core principles of underwriting mortgages is, if you have a new credit, do all your underwriting discipline. And so in our view, for uninsured mortgages, which B20 applies to, we ask lenders to underwrite new customers in full. Meanwhile, that doesn't apply for insured mortgagors because they have purchased a mortgage insurance policy.
Okay, I'm going to run out of time. So the question is, are you reconsidering for uninsured
Not
mortgages?
at this time, no.
Okay. So do you believe the government made the right choice, or did you advise the government when they made the choice on insured mortgages?
From our perspective, the rules from an underwriting standpoint, what is sound underwriting, makes sense to us. If you're taking credit risk new, you re-underwrite. If credit risk stays with the same counterparty, in the case of mortgage insurers, we don't think you need to re-underwrite.
Okay. By definition, uninsured mortgage holders are less likely to default. They have more equity in the value of a house. Why are we asking uninsured mortgage holders to effectively cross-subsidize the mortgage rates of insured mortgage holders?
Mr. Chair, what we ask financial institutions to do is underwrite new credit risks. I acknowledge that there is an imbalance from the experience of a borrower who doesn't have mortgage insurance as opposed to one that does. It's an imbalance we accept because of the sound underwriting principles behind it.
Okay. if the government has made a choice on insureds, we're creating a two-tier kind of borrower where the borrower with that has less risk to default actually it has more strenuous stress test requirements. In 2021, when stress test came in, I supported that because it made sense because rates were at an absolute rock bottom level. We're now at the top of the rate cycle, which is according to central banks. Shouldn't we be giving consumers a little bit more flexibility to shop to get a better rate?
Mr. Chair, our mandate is prudential to ensure that the lenders who provide mortgages are safe. We think in maintaining sound underwriting policies, which includes re-underwriting or underwriting new credits, even if they're switching from another institution, that's the appropriate thing to do.
Okay. Thank you. I'd like to talk about Basel IV for a second. The Fed has been very clear. They are making material changes, may even include delaying, may even put out new rules for comment again. They said they have never seen as much feedback on these new rules as possible. Why is Canada sticking to an accelerated timeline to implement Basel IV?
Mr. Chair, in implementing Basel IV, we also call it Basel III Endgame, but in implementing the new changes from Basel, Canada has is actually behind its initial schedule, but ahead of most of its peers. We moved on these because they're based on sound prudential principles that lead to a more stable financial system in our view. With respect to the final leg of the changes we're making, which is known as the standardized floor, which very complex, but it's basically a check on the models banks use to allocate capital. We are well ahead of our peers. And over the last 9 months, it's become quite evident that our lead will at least stay the same or increase. And for that reason, we've been engaging with industry to consider what the right schedule should be for that rising floor. And we'll have more for you on that this summer.
Thank you very much. So you're aware that at least some banks have said in the Canadian context it may require banks to shed about $270 billion of risk-rated assets. Like, you don't dispute that that may occur?
Mr. Chair, my math doesn't quite align with that math. But what is indisputable is that a rising floor will increase risk weights, which will therefore increase capital. And while we think that is a sound approach, it is imbalanced with our global peers. And that imbalance, the industry players argue that is an imbalance we need to look at. We would agree with that, and we've been looking at it.
Last question before the chair cuts me off. Will you commit to not making a decision until we see what the U.S. decides to do?
Mr. Chair, I don't want to make any firm commitments here today until we're done with the due diligence behind this process, but perhaps I could come back to that answer later this summer.
Thank you very much.
Thank you, MP Chamber.
And so what are some of the steps that you've taken to cool the housing market? And let's start there. Let's start there. What are some of the steps you've taken to cool the housing market? Because as you know,
right,
my constituents, all our constituents are struggling with rising housing prices.
Mr. Chair, I would reframe that slightly to say we've taken steps to make the mortgage credit system a little bit safer, which in turn may cool the housing market. But our primary objective is credit quality. So what we've done is we put in place underwriting standards, mortgage underwriting standards that we oblige all banks to follow, which causes them to make safer mortgages, which then sustains and makes their institutions more resilient. The key thing that we do, and the most important thing we do, is we set a common baseline. If all competitors in the system think they're all following OSFI's sound underwriting policies, then they themselves will follow sound underwriting policies. If we don't have those in place, they'll think, well, my competitor across the street's cheating, so I'm going to cheat because I have to compete. And so there is a game theoretic aspect to what we do. We put a baseline of sound underwriting standards in place to sustain the system through ups and downs.
That makes sense, but let me sort of challenge that a little bit. I mean, some of my constituents have said to me, well, look, like if we could make it easier for me to get a mortgage or allow me to borrow more, then I could afford to buy a house I wouldn't otherwise be able to buy, or I'd be able to stay in the house that I'm currently in and now can't afford to stay in because my mortgage rates have gone up. And so, wouldn't it help Canadians if we effectively loosened the reins a little bit and made it easier for them to borrow?
Mr. Chair, loosening the reins will typically mean, at least as I interpret it, lessening or lowering underwriting standards. In an individual's case, you're right, someone might be able to get a little bit bigger house or stay in a house that interest rates have made more difficult to afford. But over time, we would be building credit risk in the system that would ultimately, in our judgment, metastasize into a broader financial stress event that would be costly to Canada in the long run.
For the first time since the beginning of the pandemic, mortgage delinquency rates are trending up. Vulnerabilities first detected in credit card and auto loan markets are therefore moving into the mortgage market as well. This suggests the financial buffers built up during the pandemic are becoming exhausted by some households. Do you agree with that assessment? And I'm curious what comment you may have on that.
Mr. Chair, yes, I do. That's what the data indicates. What we're seeing is that rising mortgage costs and rising interest rates are first impacting households that tend to have a little bit less income. So, say in the lowest quintile of households. Those households typically do not own homes, but they do have credit cards and car loans. So we are seeing rising delinquencies in that space. And that is a concern. What I can tell you is that the financial institutions we regulate are absorbing those higher credit costs without material threat to either their earnings or their capital.
Now, OFSI also commented in May, they said the following: changes to the economic environment, such as weakening labor markets and declining rates, could reduce the payment shocks outlined above. Could you elaborate on how the combination of weakening labor markets might impact the risk associated with real estate secured lending and mortgages?
Yeah, Mr. Chair, weakening labor markets would, if history is a guide, likely be followed by falling interest rates, which would then in turn lower the refinance risk faced by current mortgagors.
And if interest rates are reduced, does this not have a risk of restarting the cycle of cheaper money, putting more people in the market, therefore putting additional price pressure on housing?
Mr. Chair, the answer to that question is yes, it does. And we implemented a policy recently on mortgage underwriting that will check the tendency of banks and homeowners to lever up in that environment. And that check is known as the loan-to-income ratio test.
Mr. Chair, do I have time for one more question? Okay, I'll throw it out there.
MP Davies, go ahead, please. Yes. Sorry.
Thank you. Mr. Rutledge, you talked about the impact of variable rate mortgages. In your view, have Canadian financial institutions taken sufficient steps to date to mitigate the risk associated with variable rate mortgages, especially those with fixed payments?
Mr. Chair, my answer to that would be a qualified yes. The folks we're particularly worried about, so folks who have that product that have negatively amortizing mortgages or interest-only mortgages. The numbers over the last 18 months have fallen from about 270,000 households to about 175,000 households. That is a result of households and financial institutions taking preemptive steps to avoid more problems later down the road.
There are risks and challenges whether the housing prices go up or go down, right? And sort of keeping it on that narrow path that I believe is one of your goals there. So I want to talk specifically though about the capital gains and of course the increase in the inclusion rate of capital gains and the impact that this will have on the housing market. So first of all, I want to talk about the way that the Liberals designed the implementation. Of course, that creating conditions for a fire sale up until June 25th, which is just around the door. Of course, that's going to, in my mind, if you're a cottage owner and you want to want to get the lower rates of the inclusion, you'll want to sell before June 25th. Do you think that this will have any material impact on the prices? And obviously, if the housing prices go down, that puts the risk of mortgages going underwater. So.
Mr. Chair, I think it's a little dangerous for me to comment on tax policy, but I'll address the question about the housing market and the effect of a sudden burst of supply. So if there were a sudden burst of supply in any particular regional market and demand was the same, be downward price pressure. We have not seen that phenomena yet in any of the major markets we cover. I'd have to come back to you on specific, more local markets.
Thanks. Thank you for that. And also, I'll maybe frame this question towards more generality, so it might be a little bit easier for you to respond to. But the other question I want to ask is also relative to tax increases. This is on home building. Your testimony earlier was that we need greater housing construction in order to bring housing prices back to reasonable levels of affordability. If, in fact, a government increases taxes of any sort, that will, of course, will reduce or limit supply depending on the amount of the taxation of various other factors. Is that correct there?
Mr. Chair, you're asking me an economic tax policy question. I'm just superintendent. Marginal increases in the cost of housing construction, I have not seen cases where that has materially impeded supply.
Right. Okay. So maybe I'll just go a little bit further on that, if I could. If it's not marginal, though, if it's material cost, the increase in the inclusion of the capital gains rate could cost a developer millions, if not tens of millions of dollars. And often these projects are marginal. They might be $1 million or $2 million either way, whether you go ahead or not. Surely you'll agree with me, Mr. Rutledge, that now is not the time to put in additional barriers for builders to build houses when, as the president, I believe, of the home builders said, there's not a chance we're going to hit our target.
Mr. Chair, I'm going to politely refrain from entering policy debate around tax policy. I will stand by my earlier statements about the importance of bringing supply into line with demand in terms of housing and household formation.
Okay. Thank you for that, and I do appreciate you trying your best there. But I just want to put a little bit. I'll switch subjects here a little bit around the sensitivity of interest rates with respect to the housing market. So, if in fact, like I said, we can get in trouble if houses go too low or too high. Are you concerned that a dramatic decrease, we've got 0.25, barely anything, but if in fact the Bank of Canada were to move too quickly, that might drive the housing prices too high? And are you comfortable with that now with the 4.5 rule or the 450% rule that we'll be able to protect ourselves from buyers taking on too much?
Mr. Chair, I think the advantage of this LTI requirement that we're putting in, I should mention it's just for institutions. It doesn't affect individual borrowers. But what it would do is that if rates did fall very low, it would act as a backstop to the mortgage stress test and tend to limit the amount of excessive risk-taking in the mortgage space.
Okay, and what about right now for the payment shock that you've talked about in your report there? If in fact the housing market caught fire again because of the interest rates or whatever, what's your level of discomfort? Is it if the housing market went up 10%, 20%, 30%, where we would start seeing issues with the housing market there?
Mr. Chair, if we saw a significant increase in prices, the problem that I've spoken to with respect to variable rate mortgages with fixed payments would actually lessen, because people facing those higher payments would have a more robust market in which to sell their homes and therefore cure their debt service issues.
Thank you, and thank you, MP Lawrence.
At a breakfast that a number of us attended yesterday with Bank of Governor officials, we were talking about housing, and I learned that in a number of different countries, They do very different things with mortgages. Some countries allow you to port mortgages over 8 years and 80 years and a number of generations. Some countries like the U.S., you could lock into a 30-year mortgage, but you have tons of flexibility in terms of how much to pay off your mortgage at any one time. And so my question to you is, have you been in touch with other regulators around the world? And is there anything we could learn from them, or ideas that perhaps we might want to consider adopting here as we're trying to struggle with the affordability and housing crisis we have right now, that you might be able to contribute to this conversation here today? Thank you.
Mr. Chair, every country's mortgage system is a reflection of its history and its regulatory policy. I would start by saying Canada's mortgage system has worked quite well. Many of my peers are envious of the track record of credit quality in our mortgage system. A hallmark of it is we have relatively shorter amortization periods, so people pay down their mortgages, and the lower your debt goes, the less risky your financial situation is. When you have longer mortgages, your debt stays around for longer, and it is a higher risk issue. The Bank of Canada has done interesting work on how to improve our marketplace to make longer-term mortgages available. So if households, if they so choose, can term out their mortgages for longer than 5 years at a reasonable price. They can do it right now. It's just the prices are fairly expensive. And I'd refer you to them. They've done a lot of good work, and they have a lot of good ideas. And in aggregate, if the product set evolved in that way, that would be a net benefit to the system because it would give mortgagors more choices to manage their personal financial risks.
Thank you, Mr. Chair. Thank you for your testimony today, Mr. Rutledge. It's been very interesting. One of the things that OSFI regulates are basically the capital reserves of the banks. What I think you call the domestic stability buffer. What ordinary Canadians could kind of think of as money set aside for a rainy day. And last year I note that, I assume out of concern for the stability of the banks, you increased that requirement from 3 to 3.5%. Now, the language that you used in your report recently, calling when people refinance or have these variable rate mortgages, when their new payments get locked in, payment shock, that's very strong language. You don't use that language unless you're really concerned about something. Now, today it sounds to me like you've kind of poured a little water on that because you kind of narrowed it down to just people who are on the variable rate without locked-in payments. But I still have a couple questions. Are you concerned enough to increase the domestic stability buffer again this year? Or are you satisfied that people are coping with their payments sufficiently that you could actually reduce it back to 3%?
We intend to make an announcement on the domestic stability buffer next week, so I won't scoop myself. What I can refer
Oh, come on, just tell us.
what I can refer you to is that in December of this year, we said that the vulnerabilities had stabilized, and so there was no need to raise the buffer any further. And on empirical data, vulnerabilities have not worsened since that time.
So why use that language? It's clearly inflammatory language in a public report. Yeah, why use that language? I mean, you don't use it unless you're concerned about something. It doesn't sound like you're all that concerned based on your testimony here today.
Mr. Chair, I guess we use the language because that's how we talk about it with the institutions we regulate. That's the language they use. Now, the payment shock, the folks that are exposed to particularly acute payment shock are relatively, it's not a lot of people. I mean, 170,000 I acknowledge is too many, but there's 5 million Canadians with mortgages. And so the issue we have with that risk concentration is, it will harm Canadians. It will the Canadians who have those mortgages if they do suffer that payment shock. It'll strain the earnings of the institutions. And it is an unnecessary risk concentration that all else equal I would have rather avoided. And I use the term because that's what we use in the industry, to be honest.
I just want to circle back to a line of questioning that Mr. Chambers was asking about earlier. You admitted that there's an imbalance, that people with uninsured mortgages have to have their credit reassessed, and those with insured. It really is kind of backwards, you know, when you, as Mr. Chambers pointed out, that people who have better credit and more equity in their homes have to go through that. You're saying here there's an imbalance, but at the same time you said you don't plan to do anything about it. So you're okay with a certain group of Canadians being treated unfairly when it comes to their mortgages compared to people who have insured mortgages? That's okay with you?
Mr. Chair, I'm okay with banks applying underwriting standards equivalently across the system. If we were to lighten underwriting standards vis-a-vis the MQR, well, that comes from Guideline B20, which also calls for new credits to have the collateral appraised, to have the income of the borrower checked. In other words, if you loosen one underwriting standard, you're probably going to loosen more. And our mandate calls on us to be fairly vigilant on this. My recognition that there is an imbalance from the perspective of homeowners who have insured versus uninsured, I hold to. It is, from the perspective of those home buyers, if I were a home buyer facing that, I would feel like it was an imbalance. The commissioner of the Competition Bureau and I have spoken about that. And I think it is a legitimate challenge to say to OSFI, can you do something different so that imbalance goes away? We are thinking about it, and I think it's a fair critique.
Okay, thank you.